When interest rates hit zero and the economy still needs a push, central banks have one more lever to pull. This is MoneyMind. Today's concept? Quantitative easing, often just called QE. It's one of the more dramatic tools in a central bank's toolkit, and it shapes borrowing costs and liquidity across the entire economy, even if you've never heard the term before. Quantitative easing is a monetary policy where a central bank buys large quantities of securities, things like government bonds, to inject money directly into the economy. Think of it like this. Normally, a central bank nudges the economy by adjusting short-term interest rates. But when rates are already near zero, that lever runs out of room. QE is the next tool, a way to keep supporting the economy even after conventional rate cuts are exhausted. So when does a central bank reach for it? Typically during periods of serious economic stress, a recession, a credit crunch, a moment where businesses and households have stopped borrowing and spending because credit feels too tight or too expensive. By buying large volumes of securities, the central bank pushes money straight into the financial system. This does two things. It lowers long-term interest rates, making borrowing cheaper for mortgages, business loans, and investment. And it increases liquidity, meaning there's simply more money circulating and available to lend. The idea is simple, even if the mechanics are big. Cheaper borrowing costs are meant to encourage people to take out loans, businesses to invest, and the economy to keep moving instead of stalling out. You'll usually hear QE mentioned during major downturns. It's the kind of policy that shows up in headlines when a central bank is trying to prevent a slowdown from turning into something worse. Quantitative easing is a central bank's way of injecting money directly into the economy when interest rate cuts alone aren't enough, lowering long-term rates and boosting liquidity to keep credit flowing. That's quantitative easing. One tool, big impact. Next time on MoneyMind, we're zooming out to international currency fluctuations, why currencies rise and fall against each other, and what that means for everything from vacations to global trade. Subscribe so you don't miss it, and I'll see you in the next episode.